Okay, welcome everyone to day one of the advanced trading course. We're going to get started here today with basically an introduction to my strategy and my approach as a trader. We'll have some time for question and answer, and let me know as we're going. If you do have any questions, you can type them out in chat and I'll answer them as we go. All right, let's see. All right. Okay, so day one, introduction to trading. So as many of you guys know, what we're talking about here is day trading. So how does day trading work? Well, the simple concept is that we want to buy stocks that are moving quickly. We only make money when stocks are moving. We don't make money in slow moving markets. So as day traders, our job is to find volatility in the market. We profit from volatility. So if the market's not moving, we're not going to make any money. So if the market's going down, if it's going up, that's good. I don't necessarily have a strong preference between up markets and down markets. As long as the markets are moving, we're going to be able to find stocks moving with the market, and we're going to be able to make money. So our job as day traders is to find the volatility in the market, find those small handful of stocks each day that are making big moves, because every single day there's a stock having a big day. I mean, occasionally we get into a slow period where there's not a lot of activity, but for the most part, we can find active stocks almost every single day. But here's a question for you. Why do most traders fail? Right? Because we know the statistics aren't good for success as a day trader, right? A lot of traders fail. And why do they fail? Well, there's a couple reasons. The first one is failure to maintain discipline and failure to manage risk. Okay, because day trading requires quick decisions, right? We have to be able to make quick decisions, and you need to be disciplined when you make these decisions. Okay, and many new traders lack either the ability to make those good decisions while under pressure, or just the ability to maintain composure while you're under the stress of a losing position, right? How many times have we accommodated a losing position by adjusting our stop loss to give it a little bit more room, right? We change our risk parameters mid-trade to accommodate losers. And that's really a big mistake, right? A loss that may have only been $100 ends up being $300 or $400 because we kept moving our stop down a little further, giving it more room. We failed to maintain the risk management principles that we use to enter the trade, and we failed to have the discipline to really stick with our stops. Okay, so skill and discipline, these are like muscles. The muscles of a day trader, okay? And we have muscle memory, and you get better at maintaining your composure under times of stress. I've talked a lot about how when I was a beginner trader, I went through a phase where once I really turned the corner and I had a few successful strategies, I was making good money, but what would occasionally happen is I'd have a period of 4 or 5 weeks of really solid green trading, and then in one day, I would make a mistake, and I would give back 3 or 4 weeks of profit. I would just go into a full snowball, just aggressive gambling type of mentality. So what was happening there, right? Because that for me, I knew was the difference between ultimate success or failure as a day trader, was learning to control that really impulsive kind of trading. So what I realized is that typically those days for me would be days that I lost money right out of the gates. So my first trade was a loser. Okay, and then the second trade I'm trying to make up for the first trade, and my judgment's a little impaired, and I take a second loss. Okay, and then once I'm down, $300, $400, whatever it might have been on 2 losses, I start to really amp up. I get a little bit more frustrated, a little bit more aggressive. I see something starting to move, and I decide, you know what, I'm going to take this with 3 times my normal position size because this is the trade that's going to get me out of the hole and green on the day. And guess what? I get a third loss, and I'm down $800 or $1,000. And that's how quickly you snowball, right? But this can happen on any scale. You could have this day where you're down $8,000 or where you're down $80,000. I mean, we've all talked to day traders who have had just absolute snowball, total blowout days where they blow up their whole account, right? So The whole reason this happens is because you allow your impulsive, aggressive nature to get the best of you, right? So uh, the most important concept to understand if you want to succeed as a day trader is risk management. And we're going to go over that a lot over the next couple weeks. Learning how to manage your risk on every single trade and always asking yourself, how much are you risking? How much do you stand to lose in any given trade? It's not about how much you can make, it's about how much you can afford to lose. Okay? You have to have a stop in mind on every single trade. Okay, so how do you find trades? Okay, so once I have found stocks that have the volatility to give us potential profit, I have to find exact entry and exit levels. So this is where I rely on a handful of patterns and strategies. Okay, I've got my flat top breakouts, I've got my bull flags, I've got my descending wedges and ascending wedges. Those are patterns. Okay, now chart patterns are very important, but we apply chart patterns to the right stocks using proper risk management and using the patterns within a larger strategy. Okay, so just trading patterns isn't quite enough. We need to define which patterns we take when, what time of day, how much size, what our stops are, and that becomes basically a trading strategy. Okay, so another important thing to understand is that you only want to take the best setups. Okay, because even the best setups might only work 65 or 70% of the time. So if you're taking crappy setups, what do you think your odds of success are? Right? They're going to start going down really quickly to 50%, 45%, 30%. And it's possible to make money with a 30% success rate, but let's aim a little higher. Right? I want to aim for 50 to 60% success rate because I know I can make money with that rate of success. So we only want to take the best setups. And that means a lot of times we're going to be sitting and waiting. So the majority of the trading day, my account is all cash and I'm sitting and waiting for the next trade. So on the one hand, it can get a little boring because there are obviously stocks moving the entire day, but we need to be patient and make sure we only take the best setups where we can manage our risk properly. That's what I learned was really one of the keys to success, is learning to wait until you have a good setup. Taking stabs on anything that's moving is usually a recipe for disaster. You're going to lose money doing that. You're going to pay a ton in commissions, you're going to trade a ton of shares, and you're stabbing at poor quality setups, so you're probably going to lose. Slippage on the losers is going to be big. You're going to make, pennies on the winners, a couple scalps here and there. It just doesn't give you the profit-loss ratio to justify that type of trading. Okay, so this is the value of patience. Learning to be patient is extremely important. You have to be able to sit tight and just wait for setups to come to you. Now, I know, and you probably all know the same feeling, that when you see a stock that's running up 10%, 20%, 30%, you just see it running and running and running. You're sitting on the sidelines watching it thinking, geez, if I'd bought, 30 minutes ago, I'd be up a ton right now, right? But that's trading in hindsight. We can all say that about anything. The real question is, was there an opportunity to enter that trade with a low risk position, right? Where we were only risking 100 and we had the opportunity to make 200 or 300. And if the answer is no, then we can't feel bad about missing the run, right? Sometimes stocks squeeze and start running and there's really no opportunity to get in a safe way. So sure, if you were in from, a long time ago, then you're a swing trader and it starts squeezing and you're doing great. But for day traders, it just may not be a good setup for us to get into. And that's okay. We have to acknowledge that. If we chase bad setups, right? If we buy a bad setup way too high and it comes down, we're going to take huge losses. It's going to mess up our risk reward ratios. And we're not going to make money doing that. So if you find that you're only taking 1 or 2 trades a day, but you make 200 on each trade, right? You make $300-400 a day, that's good money. You don't need to take 50 trades a day in order to be a successful day trader. Most of the traders I know that overtrade end up giving back a lot of profits over trading. And you can just look at the days where you do it. If you look at your own spreadsheet of the trades that you take. Today, for instance, I took a ton of trades. And it really wasn't the best approach. right? I had a bad trade right out of the gates. A couple winners then on NDRM, but overall today I overtraded a little bit. I did more trades than usual. On Friday I did 2 trades, and today I did 12. Okay, I made more money on Friday. I had 2 solid winners, and I said I'm done for the day. That's good. So don't be afraid to do that, and don't ever feel bad if you say, look, it's 10 a.m. I just made $500. I'm done for the day. You walk away. You come back at 3:30 or 4 o'clock, and you see, XYZ ran up 500%, and everyone made all this money. So what? You made your $500. That's good, right? You hit your daily goal. Put another day behind you of success in the market. That's good. So don't worry about, the gains that you could have had or would have had. Just let that go. It's really important to let that go. All right. So my strategy is pattern-based trading. Okay, I trade patterns. I've designed my entire strategy around patterns that I recognize as being very, very successful. Okay, and using pattern-based trading, I can lose 40% of the time and still make money. And it's not just because I'm trading patterns, it's because I'm managing my risk really well. Okay, I try to always have a 2-to-1 profit-loss ratio. We'll talk about that a little bit more, but I always want to have a positive profit-loss ratio. That means I win more than I lose on average, right? If you win $100 on average, but you lose 1,000 when you lose, you've got a negative profit-loss ratio, right? So you want to make more on your winners than you lose on your losers. Now, in this market, over 60% of the volume is algorithmic high-frequency trading. Okay, those are the institutional traders, the hedge funds. So we need to find an edge against those types of traders, right? Because when you look at most charts, right, most charts that you look at, and this one, we'll look at URI, which was active today, but we'll look at its chart yesterday, which was not very active. Okay, so you could look at this and say, well, looks like there's some patterns in here, but realistically, a lot of this price action is just being driven by high frequency traders instead of retail traders like all of us. Okay, retail traders are going to cause the big spikes, the clean breakouts. So any pattern that you see in this is really just a manifestation of algorithmic trading charted out. Okay, it's not really patterns that people are watching in most cases with these lower volume stocks. 60% of the market is high frequency trading. Well, we have to assume that it's going to be higher on some stocks and lower on other stocks, right? I mean, naturally it would be. So stocks that it's going to be higher on are stocks that fewer people are trading because they're easier to manipulate. Okay? It's easier for a market maker to manipulate a stock like JRJC here because no one's trading it. Do we have a flat top forming right here? Yeah, we do. But who's watching it? Nobody. And it fails. So we don't want to apply our patterns to the wrong stocks, because if we do that, we're going to lose. All right? So I found that my edge in the market was focusing on patterns. The very, very obvious places where lots of traders are going to see this is a great place to be a buyer, or this is a great place to short this stock. Okay, so pattern trading. When price action is plotted on a chart, patterns are formed. I use candlestick charts, right? A lot of you guys know this already, but I use candlestick charts. Each candle represents a period of time, and you can choose which time frame you want to use on your charts. So you could have each candle represent 5 minutes, 10 minutes, 15 minutes, 60 minutes, 1 day, 4 days, 1 week, whatever. I use 1-minute candlesticks and 5-minute candlesticks. Okay, so this is a candlestick. Each candlestick gives us 4 pieces of information: the open price, the close price, the low of that period, and the high of that period. Now those 4 pieces of information will be plotted out just the way you see here on the screen. And the shape of the candle is actually going to tell us a little bit about what's happening in the market. So a stock that has a very tall candle wick, this high upper area, this tells us that it squeezed up during this 5-minute period, but then closed down a little bit lower. So there were buyers, but the sellers came in and pushed it down. Okay, the lower candle wick, a squeeze down, and then a little squeeze back up. Okay, so this type of candle right here is actually called a spinning top, and some people would call it a doji. All right, it's a candle with an upper wick and a lower wick that is very relatively small in its whole body. Okay, that means it's a candle of indecision. People weren't really sure whether they were buyers or sellers. It popped up, it went down, popped back up, a little bit choppy. Okay, whereas the candle before, this green candle, is a very clear bullish indicator. This is a big green candle, right? There weren't a lot of sellers this day. Okay, now the shape of these candles, the green ones, the open is at the bottom, the close is at the high, and on the red ones, the open is on the top here, and the close is down here, the low. Okay, so we'll review these patterns more, but let's just look for example on this stock Zaza. Okay, what we have here are 3 candles shooting up, 3 big green candles, one after the other. Okay, 1, 2, 3 big candles. And then we have 1, 2, 3, 4, 5 candles that go sideways. Okay, so when you picture that, the 3 up and then the 5 sideways, that's called a flag. And this particular pattern is called a bull flag. Okay, what oftentimes is happening here is we get a surge of buyers, a small period of consolidation, and during that consolidation there's a little bit of selling, a little bit of buying, and then the next round of buyers come in. So these stocks squeeze up, they consolidate, coil up for a minute, and then squeeze up again. Okay, so I always look for bull flags. We'll find these on lots and lots of charts. Now the way I found this particular flag was on the surging up scanner. Okay, this is a trade idea scanner that I use. It scans for stocks with lots of volume right now. Okay, so there's that pattern there on Zaza, that nice flag and that nice volume pattern. What you notice with the consolidation of the 5 candles that are going sideways is their light volume. So we have high volume on the surge up, light volume on the consolidation, and then high volume on the second step up. And I'll always trade flags on the first and second pullback. Okay, so the first flag I'll trade, and then if it shoots up another 3 or 4 candles and goes sideways, I'll trade it again on the second flag break. If it does it a third time, I'm usually going to sit it out unless the stock is ridiculously strong. Okay, so that's an example of one of the patterns that I look for. This stock met our criteria for a lot of reasons. It was a stock with a ton of volume. It was the right price range, had lots of retail interest. Okay, a lot of buzz around the name. The pattern was perfect, and so this fit our strategy for an opening range breakout. This was a bull flag in the morning, very strong right out of the gates. Okay, now here's another chart. This is VA. Now this is more of a flat top. This is a stock that had 2 green candles and then 3 candles that were sideways with the same high, just about the same high. Okay, so we surged up in the first 2 green candles to $37.50, and then the next 2 candles kept tapping at $37.50. So when we have more than one tap, we have one tap at $37.50, a second tap at $37.50, a third tap at $37.50. We're getting what we call a flat top pattern. Okay, you could also call this an ascending wedge, right? Where the support line is ascending up and the wedge, the flat part, is on the top. Okay, and what we often get right out of these types of patterns is a breakout, a flat top breakout. This is another example of buying the first pullback on a strong stock. So at first these patterns are going to be a little bit confusing, and they certainly were for me when I first started trading. This was sort of a foreign language, but the more you look at them, the more you'll learn to recognize these patterns in charts. They'll just start to stand out and you'll see them very clearly. And then once you start seeing them, it just becomes so obvious whether or not the pattern is there. So it becomes easier to trade because you can instantly look at a chart and see, oh, here's an entry, here's an entry, here's an entry, or this chart's got nothing. It's not worth trading. So I like to have all of our traders in the chat room trained for pattern-based trading because it makes you really good traders and it makes you more valuable to me and to our community, right? Because you start calling out really good-looking stocks. You'll look at a stock like VA or Zaza and you'll say, hey Ross, check this out. This looks really good. I'll look at it, I'll agree, and we'll all buy it. So that puts more sets of eyes out on the market. Now, as I've said, there's thousands of stocks you can choose from each day. We will go over choosing the right stocks. But even though there are only a handful of stocks that are really in play each day, there are still more than any one person can watch. So it helps to have a community of well-trained traders all working together to find these setups. Okay, now, well, let's talk for a minute about what some of the other traders out there do. Because there's millions of, well, I don't know how many traders there are. There's thousands and thousands of day traders. And we may all be profitable, but all have unique strategies and approaches. Okay, this approach for me works really well. And I've got a few strategies that are based around the pattern trading techniques, and they work really well. But you should be aware of some of the other strategies that other traders use. So some traders are going to focus very heavily on technical indicators. Okay, and you can do a little research on these if you're not familiar with them, but you've got the relative strength index, moving average convergence divergence, it's called the MACD, and just simple moving average crossovers. So there's some traders that are going to rely very much on a numerical, technical indicator to tell them when to buy or sell. If the relative strength is very low, they might look to buy something off the bottom for a bounce. If it's very, very high, they might look to short something off the highs. Okay, now I don't personally really like doing that very much because I prefer to trade chart patterns rather than technicals. I feel more comfortable doing that, but, to each their own. Some day traders are going to just scalp volume spikes. Any stock hitting a high of day scanner, they're going to look at it, see the volume coming in and just jump in it for a little scalp. 5 cents here, 10 cents there, it all adds up, right? So some day traders are scalpers. They just take the little breakouts, the little pops, and leave it at that. Some traders focus exclusively on counter trend trading, right? Buying the low RSI and shorting the high RSI. So what that is basically is guessing a top or guessing a bottom. And on the one hand, guessing a reversal is really challenging, but on the other hand, when you get it right, your stop is so close because you're buying on the lows that you have a really good profit potential. So we will cover some counter trend trading strategies in this course. Okay, so with pattern trading, my feeling on this is that the more traders using it, the better it works, right? The more people watching these flags unfold and seeing the very clear line in the sand where you want to be a buyer and there's going to be a breakout, the better. That means more people are buying, the breakout's going to be stronger, it's going to be bigger, we're going to have cleaner moves, and we're going to make more money. Okay, so pattern trading is not a secret recipe to success. It's a technique that thousands of traders use, and it works because lots of people are using them. Okay? But that hints at this next thing I want to say, which is that pattern trading doesn't work on all stocks. Okay, so when we're going into the stock selection chapter, we'll talk about exactly which stocks you should be trading and which ones you shouldn't be trading. And it's really very clear. It's pretty black and white. So it's not complicated, it's just there's some stocks this simply doesn't work on. Okay, so I really like pattern breakout trading. So specifically, those are patterns that are forming, and I look to buy them as they're breaking out. Okay, so any type of pattern, basically we're using patterns as a mechanism for reducing risk, right? We want to get long a stock, but we want to find an entry that's safe. So we use a pattern as a safe entry. Okay, we get in on a pattern. Now, as the pattern starts to squeeze and is getting ready to break out, I like to buy right at that point. That's sort of at the apex point. Okay, now patterns can be forming for periods of uh, hours, days, weeks. I mean, they can form for a long, long time. And I don't always want to buy during the consolidation pattern forming phase because I can end up having my money tied up for a long time just sitting there waiting. So instead, what I do is I keep my eye on the handful of stocks that are really strong each day and wait for the breakout pattern. Okay, I wait for the pattern to start to break out and I buy right at that apex point. So when we talk about risk management, one of the factors that we'll talk about is reducing our exposure in the market by reducing the amount of time we're sitting in the market. So the fewer trades we take, the less we're risking, right? That means our money's in the market for less time. If we're holding a stock for 6 hours, we've got our exposure in the market for a period of 6 hours. So the more we can reduce that exposure, the better. Obviously, we want to maximize our profits, but it's a balancing act. Okay, so I try to reduce my exposure by not holding for long periods of time. I look to get in on the breakout and get out quickly when I have profit. Okay, so reversal patterns. This is a pattern that we'll talk about quite a bit. A reversal pattern, we need to wait for a very, very clear confirmation and buy with a stop at the low of day. Now, reversal patterns, as I indicated, are a little bit riskier because we're guessing a change in trend, right? We're guessing the stock is going to stop selling off and start popping back up. So whenever we're looking at a reversal pattern, we have to remember that we need our stops very, very tight because our percentage of success on reversal trading is going to be lower. It's because the strategy is a little bit harder. But it's okay that we've got a lower percentage of success because our profit-loss ratio is really good. When we win, we make a lot of money. And when we lose, we want to make sure we have very small losses. So lots of small losses and a few big winners. That's the way I trade reversals. Okay, so you always want to ask yourself, what's your stop? That's very, very important. Knowing your stop on every single trade. Okay, so I set my stop by default at the low of the last 5-minute candle. For me, that's a way of just saying, is the stock still moving up? Are we still trending up? Let's step back, let's pull away from the 1-minute chart. 1-minute charts can be very choppy, right? 1-minute candlesticks can go up and down, they can be all over the place. So let's step back, let's look at the 5-minute chart. If the 5-minute chart is trending nicely, then I should probably stay in this trade. Okay, so let's just look at a chart here for instance. Now JRJC, these are 5-minute candlesticks, but as you can see, they're pretty choppy. So this tells us that this stock would probably not be easy for day trading and probably just doesn't have enough volume for clean trades. Now ISIS today, this was actually a really nice stock right around the open. We had that nice pop up, some quick profits in there, really nice patterns, but midday it starts getting a little bit choppier. So obviously it bounced off the lows here of 65.50 and made a move back up to 68.40. So that's a 3-point move. But these candles are, you can tell that they break the previous candle's low. They're a little bit choppy. We've got some red candles mixed in here. You can see that there is some indecision. Even though it does make a move up, it's not the cleanest move up, so this would probably be a little bit of a trickier stock to trade. If you want to be in a stock that looks like this and is looking a little bit choppy, sometimes you have to go back to the 15-minute chart. Step back a little bit further. Okay, when you step back further, the picture becomes clearer and clearer. On the other hand, if you step back too far, your stops are going to be really, really stretched out, right? Because this is a flag pattern that has a 3-point range, $3 of range, right? So if you buy on the low of the flag, you have a potential for $3 back to the high. But if you buy in the middle of the flag, you've got a $1.50 stop, a $1.50 target back up to the high. It's not very clean. So this isn't a pattern I would typically trade. But the importance here is looking at your 5-minute candlesticks and always setting that stop at the low of the last 5-minute candle. So you could set your stop there at 66.14 if you got in on this red candle. And then every time that candle, the next 5-minute candle closes, you move your stop up. And then you move it up again. and then you move it up a little more, and a little more, and a little more, and then you would have gotten stopped out here at 67.13. That for me is an easy way of identifying the trend. Is the stock still moving up? And if it is, I'll hold on. If not, I should probably get out. Okay, now it's important to note that stocks do trend with the overall market unless they have a reason not to, right? So it's our job as day traders to find that catalyst for a stock to make a well-defined and clean move. Otherwise, everything we look at is going to be a mirror of the overall market, right? If you want to look at the S&P 500, the SPY, it's going to look choppy almost every single day. I mean, today we had some pretty clean sell-offs, but for the most part, you see a lot, I mean, there's a lot of color in here, right? Red, green, red, green, red, green, red, green. It's choppy. Okay, this is how most stocks trade. They're choppy. If you short it down here thinking it's going to flush, it's going to pop back up on you, right? Not enough people are watching this. And this is a composite, right? This is the top 500 companies. So this is just a reflection of what the overall market is doing, what those 500 stocks are doing. Okay, and this tells us that they're choppy, although some of them have some clean sell-offs. And today the catalyst for these sell-offs were oil, right? The oil stocks were selling off. So that particular sector might be trading in a little bit of a cleaner way, but overall the market is just sort of trending down. And so most stocks are going to trend with the market. Okay, so if we want to trade something that's choppy, well, we can just focus on trading the SPY. But I want to trade clean breakouts. So that means I need to find stocks with a reason to make a clean move. Okay, and that can be a little bit tricky, right? We've got to find the catalyst. We've got to do a little bit of hunting. So NDRM today. This was a stock that we traded several times. Now look at this trade here. This is one of the cleaner breakouts over 1394. Okay, we've got this pop up right out of the gates. Couple candles of pullback. We're getting that flag formation. Sideways consolidation, right? A little bit of coiling and then a pop up through the highs. The first pullback is always the strongest. This pullback formed on the 5-minute, but it remains the same. The first pullback is the strongest. The second one is a little bit weaker. And you can see what happened on the second pullback. It was a fake out. Pulled back, looked like it was going to go again, and it pulled way in and ended up not working out at all. Okay, but this was a very strong stock, and it had lots of volume, lots of retail interest. Okay, those are the key words, retail interest. Retail traders were all over this stock today. And look at the daily chart. We had a huge spike from $6 up to $19.07 in the last week. Okay, this stock is very, very active right now. It's very volatile. Volatile stocks, those give us windows of profitability, right? The bigger the volatility, the bigger the window. Now, if a stock is really, really volatile, we have to be a little bit more cautious in terms of how much size we're willing to take because we could have issues of slippage, right? And our orders not getting filled. And we can also have issues with spread. But on a stock of this price range, $13, $14, with the volume that we had today, the trading was pretty clean. Okay, so this is the type of stock that we want to be trading every day. And there is a stock like this almost every single day in the market, a stock having a big, big day. Okay, so when I say it's our job to find the catalyst for stocks to make a move, what we really have to look for are stocks reporting earnings, stocks that have breaking news, activist investors. We just have to start scanning the news. But I don't do general business news kind of reading at night. What I do is I wait till the morning and then I look at the stocks that are already making a little bit of a move pre-market. So from 8 a.m. to 9 a.m., I look at the stocks that are already making a little bit of a move, and then I look for one of those and see what the catalyst is. The fact that they're already moving pre-market tells me that retail interest is high, right? Retail traders, they can't even wait for the market to open to start buying these. So that's usually the way I do it. I look for the movers and then I find out what the news is and see if the news is good enough to cause a potential day-long runner. So I've talked a little bit about retail traders versus institutional traders. So retail traders, those are your regular traders like us, right? We may be full-time, but we're not working for a firm. We're not managing other people's money. It's just our own money. Okay, now institutional traders, they represent large amounts of capital. They're trading the accounts for their clients, for banks, right? Universities, big businesses. So they can be extremely aggressive and they can trade with very, very large positions. So it makes sense that we wouldn't want to be trading against the big money traders, right? We want to make sure we're on the same side as them. And it really, for me, just comes down to looking at the trend of the stock. And the pattern should be very obvious. If we have an obvious bullish pattern, then we're trading the right direction, right? And that's kind of the risk with counter trend trading, especially with stocks like oil. Every time they pop up, more people short it, and it drops down more and more and more. So we're sort of trading against the trend, and when we do get a reversal, it can be very clean. But the institutional traders and the big money obviously are pushing those stocks to the downside. So trying to catch the bottom is a little riskier, right? So I find it less risky to focus on the stocks that are moving up. I'm a long bias trader, so I look for stocks running up. My feeling is that long-term traders are going to be looking at these as well for swing trade positions. They're strong stocks, strong companies, gap up, go up. All right, that's my focus. Gap and go. So to give you a little more insight into what I'm thinking, I'm not a value investor. I'm not trading fundamentals. Sometimes people will come to me and they'll say, well, Ross, I see that you want to trade this gapper, say it's American Eagle, they're gapping up, but their earnings, it's gapping up, but their earnings are horrible, they're closing stores, this or that. I don't really care. I'm not making a long-term investment. I'm just trading the price action today. The fundamentals may be bad. This may not be a good sector for long-term investments. But for right now, today, it could make a 10% move, and I'm going to jump in it for that opportunity. Okay? So I focus on NYSE, NASDAQ listed stocks. I don't trade the penny stocks. I don't mess around with that stuff. I don't do futures or Forex. I just focus on the companies that are having big days. I focus on the gappers. That for me works the best. That's my go-to strategy. It's been working for a long time. Whether we have bear markets or bull markets, there's always stocks having a big day. We can look at almost any stock, and you can look back at the last 52 weeks, and you'll see one day in there that was a huge, huge day. There's obviously some stocks that trade in very narrow ranges, and we're going to avoid those for the most part, but I haven't had a problem finding good breakout stocks. Like I said, there might be a period of a week or two with slow trading where we don't have very many gappers. There's not a lot of earnings coming out, whatever. And that's okay. We have to be patient, right? We make sure we just go easy through those slow phases, don't give back a lot of profit, and then wait for trading to pick up, and then we're there ready to hit it. So a typical day for me starts about 8 a.m. with pre-market scanning. I start scanning for the stocks that are gapping up. Okay, now a gap, it's simply a stock that's opening higher than it closed yesterday. Okay, so the stock is opening higher than it closed yesterday, and the reasons why gaps will happen is due to news, right? There's news. There's something out that's causing this to gap up. People are buying it. Okay, so 8 to 9 a.m., I'm looking at the gappers. I'm creating my watch list. All right, I'm writing down the stocks that are gapping up. I'm searching for the news. I'm looking for the catalyst. I'm putting together my watch list for the day. And at 9:30, I'm ready to take my first trade. I often start trading at 9:30 and 1 second. As soon as the bell rings, I usually am ready to start trading. I'm a quick trader and I make the most money in the first half hour of the day. Okay, so I'm most aggressive from 9:30 to noon, 9:30 to 10 a.m., especially using my gap and go, momentum, and reversal strategies. Those three strategies are the core of my business as a trader. Okay, from 12 to 4, I go easy. I slow down. Occasionally we'll have a runner that's really strong, and I'll be able to trade it in the afternoon and get some size and have a really nice winner. But for the most part, afternoons are slow. If you decided you didn't want to trade in the afternoons, you wouldn't be missing much. Obviously there's going to be a day here and there where we've got big news that comes out in the afternoon and it's a massive winner, but we're going to have days where we have huge losers in the afternoon, right? Afternoon is choppy. And this leads in pretty well to the next slide, but for right now, I'll just leave it at afternoons are choppy. Focus your trading on the morning. Try to get a cushion right out of the gates. Psychologically, it's the best thing you can do to get a winner out of the gates. And sometimes that means taking a small profit, right? You're up 10, 15 cents, take the winner, right? Lock it up, take the winner. Give yourself that cushion. Give yourself that win in the morning. A lot of these stocks I trade out of the gates, even today, I took a loser out of the gates, but the stock was up 20 cents before it came in. I could have had a 20-cent winner, but I was holding on to it, thinking it was going to go further. But there's nothing wrong with taking profits out of the gates when you have a nice quick winner. The first 10 minutes of the day, for almost every stock, we're going to see the highest volume for the rest of the day. That's when we're going to see the most volume, and volume makes trading easier. Okay, so the market psychology, now this is just something to think about. Traders that make their goal from 9:30 to 10 a.m., what are they going to do, right? They make their goal. A lot of them are going to say, hey, look, I made $500, I made $1,000, I'm calling it a day. They take their money and they run. Who's going to stick it out for the whole day? The traders that lost money in the morning and are trying to dig themselves out of the hole. Okay, so that means if you keep trading, you're going to be surrounding yourself with aggressive traders who are trying to revenge trade themselves out of the hole. They might be taking 10,000 share positions, marketing in, marketing out, just trying to stab at anything that moves. Right? And what happens when you market with 10,000 shares? You get a quick spike up. What happens when you market out with 10,000 shares? You get a quick spike down. Afternoon trading, the market is choppy. And I think it's the result of a lot of traders being super aggressive, and I don't think it's a good idea to trade that time of day unless you have really clean setups. The easiest trading is the first hour. It always has been. I don't expect that to change. Okay, so try to make your goal by 10 a.m., 10:30, 11 a.m. at the latest, and then slow down. Okay, so midday, it's lunchtime, right? The big money, they're at lunch. They're probably going to be at a 2-hour lunch drinking martinis. Okay, so from 2 to 4 p.m., we can get some end-of-day runners. That can happen, right? We can have a stock that has news at lunchtime, consolidates near the highs, and we get a nice breakout in the afternoon. We definitely see those. But just remember that afternoon is not the time to get super aggressive. So just go a little lighter. So if you want to trade, what do you need? You need charts, right? You need to be able to see the charts. So I use eSignal. You need a broker. I use SpeedTrader. You need stock scanners. I use Trade Ideas. And you need news, right? Social media is great. StockTwits, Twitter, this is really helpful for finding out a lot of the news. You can also use a streaming news service like Benzinga, which I use, and I think that's great as well. They give you news throughout the day over the audio, so it's like a radio for trading stocks. Okay, so it keeps you company on a slow day, and sometimes they come up with some really great news stories before it gets to the rest of the people on Twitter and that sort of thing, so you can get a quick entry. And we had a couple of them today, one on Gilead and the other on NPSP. Okay, so in terms of the charting software, like I said, I use eSignal. I focus on the 5-minute and the 1-minute charting time frames. You can download my layout from the website if you're interested. That's available for all of our students. I use very few technical indicators, right? I'm not a technical indicator guy. I was when I first started trading. I had all the indicators on my charts, but honestly, I got indicator overload. I had so many I would get false positives. You'd have a set of indicators that are all telling you this is a reversal point or this is a bullish breakout coming up, and then it doesn't go and you're like, what the heck? You find another set of indicators that would have given you the right entry. They work for a while, then they don't work, and it's just in my mind they're a middleman, and if you can get the information directly from the candlesticks, you can bypass the middleman. The indicators, they're just taking the candlestick price action and converting it into a different sort of visual representation. And that can be helpful for MACD, the moving average convergent divergence indicator. It can be helpful to see when a stock is really, really oversold. It gives you that quick image of the context, right? You just look at that indicator and now you know. But you should be able to see that just looking at the chart. So that's my focus. I have a few indicators I use. Some of them are on my charts for the benefit of students to help make it a little bit more clear. But for the most part, I would not try to find the Holy Grail indicator combination because it doesn't exist. Simpler is better. Okay, now with TAS Market Profile, that's a suite of indicators that are available on eSignal, and I use them. I find them helpful. It basically, like I said, it just gives you very clear context of the current price action. Okay, so when you're looking at that, it just tells you it's like red or green. You're either bullish or you're bearish. You should either be a buyer or a seller. It's just very, very clear. And it is used by thousands of hedge fund institutional traders. It's on the Bloomberg terminals. So, I find it helpful. I think it's especially helpful for new traders just to have that sort of extra visual right there. Just gives you sort of the picture of the market. So I think that's okay. But like I said, go easy on the indicators. I don't think they're the most important thing. Now for brokers, the way I trade, I need hotkeys. And we're going to go over this later in class, but hotkeys are an absolute must. Okay, they allow instant orders. All you have to do is press Control 1 and you just bought 1,000 shares of whatever stock you typed in. Okay, so it's so quick. I press Control Z and I just panicked, sold out of my entire position, and I'm back to cash. It's that quick. I don't have to fumble with orders. I don't have to go through confirmation window after confirmation window. I press 2 keys and I'm in 5,000 shares. I press another 2 keys and I'm back out to cash. It's that quick, right? And when we're trading at the open, stocks are moving very quickly. We had a stock on Friday that surged up about 60 cents out of the gates. If you take 5,000 shares, that's a huge winner, right? That's a really big winner. You take 10,000 shares and you're up $6,000 in about 2 minutes. So you need to have the tools to place orders very quickly. So hotkeys are a must. Any broker that has them is one that you should be looking at. There's a lot of brokers, the full service brokers might not offer them, but the brokers that cater to day traders will have them. So hotkeys are a must, and level 2 is very important. And obviously, if you're day trading a lot, you need aggressive pricing, right? If you're trading at a broker that charges you $10 a trade, and you do 20 trades a day, that's $200 in commission, right? That's $52,000 a year that you're paying your broker. That's coming out of your profits. So you need to find a broker that has better pricing if you plan on being an aggressive trader and doing, 20, 30 trades a day. And that's 20, 30 orders. Right? So if I do 10 trades, I usually do 1 buy, sometimes I do 2 buys, and I usually do 2 sells, sometimes I do 3 sells. So just one stock between the buying and selling for me could be as many as 5 orders. Right? So 5 orders times 5 unique names, it's 25 trades, 25 tickets. Right? So it adds up quickly. Now, all brokers are going to give you 4 times leverage. This can be very dangerous for new traders. You have to learn how to use the leverage responsibly, right? You don't want to be maxing out your buying power, doing stupid trades, trading bad patterns. But I think leverage can be used appropriately, and it can help you build your account faster than if you didn't have it. So I think it's good. You just have to make sure you're managing your risk properly, and we'll be going over that in one of the next classes here. Okay, so just remember, go easy, but we will review risk management very soon. With the scanning tools, trade ideas, I absolutely love them. All of our students get a copy of my trade ideas scanners, so you can check those out. You need a subscription to Trade Ideas to use them, but I highly recommend it. It's one of the best tools that I use. It's where I find almost all my trades. Right? I look at the scanners. The streaming news feed, I use Benzinga Pro for the Squawk Box feature. Um, they tell me when something's spiking, option activity, takeover speculation, stock halts. They keep me in the loop of everything that's happening. So that's really valuable for me. Um, Now with the news stuff, when we're trading news, you always want to let the dust settle a little bit. You don't want to just slam orders as soon as you hear something is spiking. That can get you into that impulsive trader kind of mentality. And if you're having a bad day and you think, oh, I just heard news, there's something out on Facebook, I'm going to buy 10,000 shares of it. And next thing you know, you're down, $5,000. I mean, it can happen very quickly. It's happened to me. It's how I learned not to be impulsive. It was learning the hard way. So hopefully you guys can avoid some of the struggles of learning things the hard way by just learning when I'm teaching you here. But with the news, you don't want to be impulsive. You just want to let the dust settle. But it is good to know what the news is. If you're trading completely blind and you don't know the news, there could be a stock that runs 200% during the day and you don't even know about it. Right? So there's a lot of opportunities for volatility in the middle of the day due to breaking news. Right? We make money on volatility, so we got to keep looking for news. Now, the ebb and flow of the market. As I said, there's times when the market is really strong. We've got lots of earnings. Things are just going really well. And there's other times where the market is a little choppier and we're not having as many of the good gappers that we want. So, holiday seasons, things like that. There can be times of the year where it's just a little slower. And it's good to be able to taper your risk up and down. Just adjust it for market conditions, right? We have to be able to adjust our strategy and be flexible. We don't want to have just this is the same size we take every single day, completely, disconnected from some of the factors in the market that can create better or worse conditions. Now we can look at the macro channels on the SPY and draw trend lines, and you can see areas where we could be topping out or bottoming out, and this can give you a little bit of a context of the greater price action of the market, right? Is the market toppy? Are we due for a pullback? Now, a lot of times when I'm trading, I'm focusing on stocks that have such a strong catalyst that even if the market is pulling in a little bit, it doesn't matter. But if you're noticing the market is choppy, it's a good idea to check the greater market conditions and see if there could be a catalyst for that choppiness, if there's a reason why we're seeing that type of difficult trading in the market. Okay, so through this course, you're going to learn my trading strategies, and the three that I rely on the most: gap and go, momentum, and reversal strategies. Those are the three that I depend on for my income. Okay, so when you're trading, you need to be trading a written strategy. If you're going to put real money on the line, you need to be able to say, Ross, I was trading the gap and go strategy. This is where I was a buyer. This is where I was a seller. It worked or it didn't work. But this is the strategy I was trading. Right? You have to justify why you're worth investing in as a trader. Okay, because you could put money in mutual funds, you could invest money in other places, and those would probably be safer than just haphazardly trading anything that's moving. You need to live trade written strategies that have a track record of success. Okay, so you need that historical data, and that comes from paper trading or trading small positions of like 100 shares. Okay, so either one is suitable, but you need some historical data to back up why a strategy is worth putting real money into and why you're worth trading that. Okay, so you want to be really careful about live trading new strategies. The risk is that you don't know all the intricacies of the strategy, you don't have it worked out yet, and so your first trades when you're taking it are going to be riskier. You're going to have a much higher probability of losing money. Okay, now you also have to recognize that we all have our place in the market. Whether you're good at spotting reversals, consolidation breakouts, coiling patterns, we all sort of have a natural eye for different patterns. And you'll find yours, as you trade more and as you see more charts, you'll just naturally start to hone in on certain patterns. But it's possible that you don't actually know what you're really excelling at because you haven't looked at your data. So if you track your data, you can look at your percentage of success by each strategy. And this again is the importance of trading a unique and qualified strategy, because you can go and sort your data saying, okay, I know these 150 trades were all gap and go strategy trades. Okay, I'm 65% successful. This is my profit loss ratio, and you have that data behind the strategy. Okay, now if you're trading reversals, you can look at your stats and see, okay, well, I'm 75% successful. I'm really good at these. You'll just naturally have a spot where you're excelling in the market, but you might not know if you're not tracking your data. So again, all of our students have access to our Excel doc that we use to track our trades, and I'd encourage you to use that and see what you find. Right? You might be surprised. If you can be good at just one strategy, you can tread water in the market while you learn. This is a market where you simply survive until you can learn. But the harsh reality is that a lot of traders are unable to survive the learning curve. They blow up their accounts, they lose all their money, and they're done trading before they even got over the first hurdle of really, getting over that curve. Okay, so get good at one strategy, and that strategy should be able to carry you until you can build up to a second strategy and a third strategy. Okay, so gap and go is the most consistent strategy for me. Trading out of the open, trading the gappers out of the open. Okay, I also think the reversal strategy is very good and the momentum strategy is good as well. But gap and go is my favorite. Right? You guys that are in chat, you see me almost every single morning. I'm hitting a gapper out of the gates. 4 out of 5 days a week, I'm able to hit my goal in the first 15, 20 minutes of the market being open. Sometimes in the first 2 minutes. Right? When something surges 60 cents right out of the gates and I've got 2,000 shares, I'm up $1,200 and it's 9:32. I can call it a day. And it's not luck, it's a pattern that I focused on. It's a strategy that I trade every single day. Okay, so get good at one strategy. That can help you tread water in the market while you're learning. You're going to keep learning. I'm still learning. Okay, traders that have been trading for 15 years are still learning. You're always learning. You're always going to build new strategies, learn new patterns, identify new things in the market that you didn't know before. The most important thing is that while you're trading, while you're learning, that you're at least treading water and not losing money, week after week after week. If you've been in that position, then it's really important to step back, slow down, paper trade for a little bit, rebuild your confidence, and then come back at it with a clean strategy and a fresh approach. Okay, so anyone that's watching on the recast, feel free to shoot me an email with questions. We will go over questions here in class, but anyone that does have questions, feel free to shoot me an email and I will answer them as soon as I get them.